Okay, so part 3 of this video is we need to get back on the growth rate here and figure out how much do we think Bed Bath & Beyond is going to grow their free cash flow over time. Now the way this spreadsheet does it is it takes your growth rate and it assumes, going down here, that growth rate over a given period of time. After 3 years, it says that there's a 10% decay in that growth rate, and then after another 4 years or so, it says that there will be another decay in that growth rate. So we're not saying it's going to be 25% forever, which a lot of models do, and it can overestimate the cash flow. If we grew at 25% forever, we would be bigger than the U.S. economy eventually, which doesn't make sense at all. So we have this decay over time here. And that rate of growth, even with the decay, stops at year 10. So we only assume a growth rate over the next 10 years like this. And then we get into this terminal value, which is the value that we see it growing after 10 years. Do we see it growing a little bit? Do we see it growing a lot over the next 10 years after these 10 years? Do we see it declining? Do we see this business being a flash in the pan and then it'll die off after 10 years? This terminal value is what we expect the growth rate to be over the following 10 years after that. So that's how this valuation is calculated, is that it calculates your growth rate over time here, and then it uses the terminal value afterwards to get you a valuation. And we only go out 20 years on our cash flows because we only assume that the business will be around for the next 20 years as a conservative metric. We don't want to go into a perpetuity calculation to increase our margin of safety. So getting back on this 25.7% growth rate, I find this rather high. And given the 10-year growth rate is 12.7%, the median is on this, I would say that 12.7 may be a little bit more reasonable. And I would say it's more reasonable for a couple of reasons. Retailers as a whole may be slowing down. 25% per year seems slow, or seems high. So retailers as a whole may slow down. It's a very competitive industry, so I don't want to assume that they're going to go into every market and continue to grow at this rate. So maybe 12% is a fair number. So if we put 12% in there, I think that's reasonable. In addition to that, I'm going to add a premium on here of 3% to the growth rate just because they're buying back shares. As a shareholder, my personal free cash flow per share is going to grow based upon their share repurchasing. Given their history of buying back shares year over year, I can say that my cash flow per share is going to increase faster than the business's free cash flow because I'm getting a larger slice of that pie as well. So I'm going to add another 3% to that. So I'm going to say 15.7 is a reasonable growth rate to use. So the last piece of the puzzle is this terminal value. What do I think they're going to grow at after the next 10 years? Do I think they're just going to stagnate and they're not going to grow anymore and they're just going to be this cash cow? Or do I think they're going to continue to grow rapidly? I'm going to say, given their market and their purchasing power and their ability to maintain their moat, they're going to be able to keep a 3%, keep up with inflation growth rate. They've had the purchasing power and pricing power to pass on price increases to their customers. So I'm going to say, given an inflation rate of 3%, which some may say is low, given the economic conditions right now and the printing press is running, but let's say 3% is a pretty stable inflationary rate. And I'm going to say that they're going to be able to pass on that inflation rate going forward. So I have my 3 metrics in there, my terminal value in there as well. So I'm going to hit refresh and see what I get for my valuation. So as you can see here, today's price, today is January 12th, 2013. The current price is $56.27. Based upon my inputs, I get a fair value of $130.39. Given my margin of safety, which is 50%, I want a 50% discount to fair value. It says I should be buying anytime it's under 65.19, which gives me this margin of safety of 57% today. 56.27 is and 130.39. That difference is 57%. So, given my margin of safety, this looks like a buy to me. This looks like a company that I should be investing in, given my parameters and my analysis on the stock and my margin of safety and my conservative nature. So I like it. I like Bed Bath & Beyond this. In addition to this free cash flow metric, I also wanted to make sure that we have owner's earnings done as well. So let's refresh this real quick, and let's see how owner's earnings does. Now, owner's earnings is the money that we can take out of the company as the owner, as opposed to free cash flow. A little different, and Buffett goes into great detail, and he's the champion of owner's earnings as being the valuation metric. I like it as well, above free cash flows. So let's go through this one last, and we'll give our recommendation on where I think we should be going on this. Of course, my recommendation is just my opinion. I'm not recommending you buy or sell, and this is not advice and all those other legal disclaimers. So you're going to have to do your own analysis and come up with your own opinions using this spreadsheet. So if we look at, it's pretty close. 940 and 906 is our adjusted. So let's clear this out real quick. So we start with. So given the metrics that come up, the default settings on the spreadsheet. Okay. So we start out. We have 995 as the owner's earnings free cash flow, which was higher than the normal free cash flow by a little bit, and 906.8. Again, I'm going to take the average of those two. That looks like it's about 950. Again, we use very broad brushes here because we'd rather be somewhat in the ballpark right as opposed to being precisely wrong. So we're going to use nice round numbers here to keep our analysis simple. Okay. Again, our 12% discount rate, I was using 7% before. Again, I still have the same feeling on their cash flow as I did before on the free cash flow, so I'm going to keep the discount rate. I'm going to keep the terminal growth rate the same as well. I think that analysis holds also on owner's earnings. The growth rate drops though on this. The default growth rate drops from that 25% we saw in free cash flow to 13.3% also. I knew this before starting that analysis, so I kind of got to the same spot on that. If we look at owner's earnings, 12.4% over the last 10 years, 14.1%. I feel pretty good about this number. It's close to where my free cash flow analysis was, so I can get on board with 13.3, and then I'm going to add my shareholder increase in there of 3% because they're purchasing the shares back, so mine will grow. So I'm going to give them another little nudge up just for purchasing shares back. So I'm going to say the growth is 16.3 here. You notice we discounted back the free cash flow, but I'm increasing the owner's earnings. Now we can agree to disagree on how that number comes up, and I'm always looking for new ways to calculate these things. So any input you have into how you would come up with a growth rate on a company like this, I would love to hear it in the comments below. Same with your discount rate, also give me your input there. So I get 16.3% growth rate on this, which I think is a fair assessment. So I'm going to hit my refresh button. Again, I get a fair value of 136.78 on that against my 56.27. It's telling me I have a margin of safety of 59%. So, what does that mean? It means it's a buy. I've done both my owner's earnings and my free cash flow, and I've hit my margin of safety. This is telling me that given my parameters and my risk profile, this is a buy. I want to stress this as well, and I want to make sure that this is nice and big for you to see. If you look at this comment that Jay put into the spreadsheet here, warning, do not play with the numbers to make it seem like a good investment. This is absolutely true. Given I have a company here that looks like a buy here. It may look like I fudged those numbers to get there, but I went through multiple companies where I just couldn't get to that margin of safety, and um, it didn't make sense to buy. Don't play with these numbers until you get it to tell you to buy it. I would highly discourage you from doing that, and in your analysis, try to be as objective as possible and move on. There are so many companies out there you can look at with this sheet that there are plenty of investment opportunities for you other than a particular company you're looking at. Don't get caught in get caught into the mindset that I put all this analysis in, I better be buying something for all the work I put in. You can pass, and you should pass most of the time. So that is my quick valuation on Bed Bath & Beyond. My goal was to do this in 5 minutes scenario, but apparently that didn't work, and I'm about 10 times that range here. I'm going to try and tighten these up as I move along, but there was a lot that I wanted to get off of my chest and get out there for you so you understood where I'm coming from. So if we do this again in the next week or 2 weeks, you understand where my mind is when we're doing this, and maybe we could tighten up this time frame. So in conclusion, I am a fan of Bed Bath & Beyond. I think it is a buy. I think it's a company that makes a lot of sense to be in. The last thing I think I need to point out is we do all this financial analysis. I think we have to also take into account the real world when we're doing our analysis. Does this analysis pass the smell test? Does it make sense on a common sense level? Let's think. What are the threats to Bed Bath & Beyond? What are the threats to their business model? People are always going to need bed sheets. They're going to need forks. They're going to need knives. They're going to need blenders. They're going to need toasters. They're going to need all of those products that Bed Bath & Beyond provides and sells. And they can get those products at a number of places. They can go to Walmart, they can go to Target, they can go online, and they can buy them. The Walmarts and the Targets of the world have been around for a while, and they have competed with Bed Bath & Beyond in those markets, and Bed Bath & Beyond has survived. They've maintained their margins as we've shown, even given that competitive climate. The real challenge is going to be, how does online affect them? How does online retailers affect Bed Bath & Beyond's business? Amazon is obviously the big elephant in the room in that area. So let's think about what they sell compared to what Amazon would sell. Yes, you can buy pretty much anything that Bed Bath & Beyond sells on Amazon, but they're not products that you would buy online. They're Christmas gifts that you go to the store and you just pick up. Linens, you don't typically buy your linens online. You want to see it, you want to touch it, you want to feel it. They sell products that don't suit themselves as well online as other products like electronics do, where you can go to Best Buy, look at the TV, say that's great, I'm going to go order it online. It's stuff that when you see it, you want to buy it. Oh, that's cute, I'm going to buy that because I think that's a pretty dish, or that's a nice set, or that's a nice decoration for my house, or those are nice bed sheets. They're more impulse type purchases, not impulse like a candy bar, but an impulse where you see it, you like it, then you just buy it. You don't go and you shop for the best price on it. So I think they have a nice protection there given their business model. Okay, that's all for now. Please let me know what your thoughts are on the video and my valuation. If you agree, disagree, if you like the way I presented this, please let me know. If you disliked it, please let me know. I'm going to try and tighten this up going forward so that we're not into 45 minutes worth of analysis. But as you can see, you start looking at this stuff and you get on a train of thought and you just keep going. So I hope to see you next time, and take care. Good luck.